Okay, the next company I'm going to talk about is a company called Caltex Australia. And I'm going to look at the forecast here, and we can see the forecast of net profit. Let's just go right down to the bottom of the P&L. And net profit was 522, then 555, 617. You know, this type of business, anything related to energy, tends to be very cyclical, and we can see that here. But it's very hard to forecast cyclicality. So right now the forecast is just a stable forecast. Now that's not the topic of this particular discussion. We could discuss more about how to deal with these type of cyclical companies. But what I want to see here is just look at the net margin. And let's say that the net margin is pretty reasonable. It's a flat net margin, 2.6. Let's again take away the cyclicality. But what I want you to focus on here is that the interest income is basically zero. So let's take a look at the balance sheet and really understand what's going on. So the first thing is that in the balance sheet, we can see that the cash, the company had 53, then 264, and then boom, 858. That's a lot of cash. Now we can see in the forecasting of the cash versus sales that it's jumped from 1.3 to the forecast of 4. So I would make this forecast, let's just make it back at 1.3. And already that reduces the cash level very, very significantly here to a level that's maybe more reasonable. Now the next thing that I want to look at is the amount of liabilities that the company has. So I'm going to shift over here and I'm going to look at short-term loans and understand what's happening here. Now what we can see from this is that short-term loans go from nothing to 466. The first thing we want to look at is understand about asset growth. So here we can see on line 185 that the asset growth is about 15 or so percent. Yeah, maybe not that bad. It was negative in the past. It's hard to say what that actually would be. So then what I do is look through the rest of the items and see if there's any long-term borrowings or anything else. Nope, there wasn't. So what we can see is that because the company's going to grow at 15%, we're going to see that they're going to borrow a little bit of money. So that is a plug. Now it could be that our asset growth was too high. So one of the things that we could do is if we cut down, for instance, fixed asset growth of this company has been on average about, let's say 6%. So what if we change the 10 to 6%? What would happen then? We'd need to borrow less money. So you always want to look at this overdrafts. You want to look at your cash levels and the overdrafts to understand what you're doing there, right? And so this gives us a little bit idea that slowed down the asset growth. And I think that if we look at the assumptions on liabilities, it looks like it's probably reasonable. So I'll leave it at that. And that gives you a little bit of idea about what we're looking at in this case, which is the cash level. You don't want too much cash because that's just unreasonable. And the overdrafts, meaning the amount that you're borrowing.